So in our work, people ask all the time, how do depreciated assets impact a charitable gift? And what you might be surprised to know is, in many cases, depreciated assets are the best kind of charitable gift for certain assets. So let's talk about the typical ones. Investment in commercial real estate. If the commercial real estate has been depreciated down over time, there are two things that are happening. Hopefully, you've got appreciation, that is increasing the value of the property. Two, perhaps if you had financing, the mortgage is being paid down over time. And three is the depreciation. So you've got the appreciation and the depreciation on the asset, which is doing nothing but lowering the cost basis each year, the tax basis, but increasing the gain in the property itself. So if you play that out over 15, 20, 30 years, or what we see all the time is where you have 1031 like-kind exchanges going from one piece of investment or commercial real estate to another, that cost basis just keeps rolling each time, and then that becomes a depreciable item as well. So over time, you can end up with a very high-end piece of real estate with very low or zero cost basis because of depreciation. So we'll talk about some of the opportunities there and some traps, but those are very, very good assets to look at as it relates to charitable gifts of either life income gifts, charitable remainder trusts as an example, or outright major gifts during life. The second kind of asset are tangible property used for business. So we're working on two right now, two planes that were both used for business but had been depreciated down over time. You can have machinery. We've done something with a combine in Kansas, or potentially cars at very high-end kind of cars, so higher-end planes, higher-end cars for obvious reasons. But in those cases, those also can be used as a charitable gift, although generally speaking, those are not capital gain assets. Those are ordinary income assets. So in most cases, the deduction is limited to basis, but you don't have to pay any of the capital gains or recognize the, the ordinary income, don't have to pay any of the ordinary income tax that would otherwise be levied on that appreciation. And then limited partnerships or LLCs owning depreciated assets. So while that's a wrapper, the limited partnerships and LLCs are, of course, a look-through entity or pass-through entity. So if there is a limited partnership, let's say, that has commercial real estate that has been depreciated down over time, giving at the limited partnership level doesn't recapture, in most cases, any of that depreciation. So we'll talk about, again, some of the opportunities and the traps. So going first to opportunities, capital gain assets that have been fully depreciated under straight line, this is a key point, straight line depreciation method can make wonderful gifts because, as I mentioned, low tax basis, high capital appreciation. I think there are about 8 different ways of depreciating assets. Straight line is generally the most common way, but you have to be careful when we get to the traps to determine what kind of depreciation method was used on the asset. But if straight line depreciation was used, that is a great asset to potentially give, assuming, again, no debt or other kinds of issues. So let's talk about traps. So really depreciation is the key sort of trap if it's not straight line. So if it were more aggressive, so an accelerated depreciation or modified accelerated cost recovery schedule, then the amount that would otherwise be deemed ordinary income is recaptured as a dollar-for-dollar reduction in the charitable deduction. Say that 5 times fast. What that means is this. Let's say you've got $1 million piece of commercial real estate, and let's say under straight line depreciation, you would have had a $200,000 adjusted tax basis. So $1 million property, $200,000 of tax basis under straight line. But let's say you took a more aggressive schedule, an accelerated schedule, and rather than having $200,000 of basis, you have $100,000 of basis. That property can be donated then to a public charity, full fair market value deduction, all of that is the same process, qualified appraiser completing the qualified appraisal, Form 8283, all the same process until you get to the fair market value of the deduction is $1 million. But recall, the accelerated depreciation was at $100,000 as the basis, straight line at $200,000. That means it was over depreciated by $100,000. So that portion is recaptured not as an additional tax, but as a reduction from the deduction. So instead of the $1 million fair market value, it's now $900,000 would be the charitable income tax deduction. And that's how that's handled generally for any kind of accelerated depreciation. Still can work quite well, and think about it this way, because they have over depreciated it, you can't get a deduction for that amount because you'd be double dipping. So this is really resetting it or truing up where the depreciation schedule should have been under straight line. So it's as simple as that. If the asset, however, has a negative cost basis, which comes up from time to time, usually on limited partnership gifts, especially some of the pre-86 limited partnership gifts and others, it's important to note that the donor will have to recognize a capital gain tax from the negative basis, let's say negative $10,000 is the basis, up to 0. So it's a long-term, typically long-term capital gains tax that's recognized at the time of the gift. So donor makes the gift of the limited partnership interest over to the charity, and when making that gift to the charity, immediately has to recognize $10,000 of long-term capital gain to get the cost basis back up to 0. So those are the ways to deal with and assess whether depreciated assets would make sense for a specific donor or client situation.